Hey guys, what is the difference between a stock split and a share dilution, or when a company issues shares? One of them hurts investors and the other one just makes the stock seem cheaper. But which one is which? This was confusing to me when I first learned about them, but the best way to learn how to distinguish the two is by looking at the following examples. Look at this pizza as a company that has four shares. You own one slice of a pizza that is cut in four slices. That means you own one out of four, or 25% of this company. With a stock split, for example, a 2-for-1 stock split, you are splitting each piece into two, which will double the amount of slices and the amount of shares that you own. So you will end up owning two slices out of the eight slices of that pizza. Your ownership ratio remains unchanged at 25%. With a share dilution, however, a company can decide to issue more shares by making the pieces smaller so that they have more slices to sell. For example, this company doubled the number of slices from 4 to 8. The number of shares you own, however, remains at 1. Your ownership changes from 25% to 12.5%. But what happens to the price of the company? Let's take a look at how it's affected. Let's say that each share of the company sells for $25. This means that the company's price as a whole is $100 because $25 times 4 shares equals 100. Because you own one share, your ownership is 25%. With the 2-for-1 stock split, the price of the stock will be divided into two, which is $12.50 per share. The number of shares you own also increases to 2, so your ownership remains unchanged because $12.50 times 2 shares is $25 out of 100 is still 25%. On the other hand, when the company issues more shares, the price of the stock remains the same at $25 per share. The number of shares you own remains unchanged at 1, but it's a smaller piece. The total price of the company increases from 100 to 200 because the number of shares increases. Since you still own one share, your ownership is reduced to 12.5%. You have been diluted. In essence, companies split stocks to make their stocks seem cheaper, which can increase liquidity and trading activities, potentially attracting more investors to the company's stock. A lower stock price after the split can make the shares more attractive to retail investors. On the other hand, companies issue more shares to raise money, which hurts current investors as their shares get diluted.